Grease, oil, and China. Oh my. Oh my is right. It's been quite a week with these three things in the news, especially, well, Greece gets a lot of the attention, but we'll talk about the others. They have wreaked havoc on the markets. In fact, really, 2015 has been a tough year for the markets. Pretty much every asset class is down. Stocks, bonds, REITs, real estate investment trust, commodities. So it's been kind of an interesting year so far in the markets. Most portfolio balances are going flat or down a little bit. But this week has been particularly offsetting for many people, many investors. We've had a serious roller coaster in the markets so far. Just in the past week, since all this Greece mess has really been going on, we've seen the Dow Jones have a 2,200 point move up and down over the course of the week. So from point A to point B, it's been pretty flat, but in between those 2 points, it's been extremely volatile. And I have a feeling that we're going to continue to see this kind of volatility going forward. And I'll kind of explain why. But, the first thing is, why are we even worried about Greece? I mean, seriously, Greece. They have the size of an economy equivalent to Miami. So we're basically worrying about the economy of Miami affecting the entire world. And it's a little bit deeper than that. I think Greece is kind of the canary in the coal mine for a lot of countries. But let's kind of look at just what's going on. Let's put it in perspective. And then we'll talk a little bit about where I think it's headed. So Greece is looking at a total debt ratio. The government has about 323 billion euro in debt. And it's really broken down. The vast majority of the debt is owed to other Eurozone countries, 60%, in fact. Then they have about 10% to the International Monetary Fund, 6% to the European Central Bank, and then there's other entities that own money as well. So, it's really not that big, but the problem for Greece is their debt level is 174% of their gross domestic product. So that means they have $1.75 of debt for every dollar of economic activity the country produces. So it is a big deal for Greece. And what we're finding is this is a situation where you just have way too much debt. And at some point, no matter what you try to do, if you have too much debt, it's going to end up being a noose around your neck. Now, the one thing we do know about Greece is the bankers always win. So Greece had an issue. They got their first bailout just back in 2010, 2011. So we had the same Greece issue just 4 or 5 years ago. And what had happened back then is most of the money owed at that time was owed to banks. It wasn't owed to the countries themselves, the other European Union countries. It was owed to the banks. So they did a bailout, of course, and changed some of the rules, put a little austerity on the Greeks. And essentially what this did is it gave the banks time to offload the Greek debt that they had, right? So Greece, in theory, and I'll talk about it in a second, should have defaulted 4 years ago. Had they done that, the banks would have taken it on the chin. Instead, what eventually happened, as it always does, is the banks put their bad debt onto the taxpayers through the countries. So in fact, when you look at it, if you look at the Greece bailout, they've already received $284 billion since 2010 for their bailout. 92% of that went to the European financial institutions. Only 8% reached the people of Greece. But the people of Greece have a nice little surprise for them. Their debt's gone way up. So like I mentioned, now we're looking at debt to GDP of 174% for Greece. So their debt level's gone up. The Greek citizens owe a boatload, and it's gone up considerably since 2008. So the bankers have gotten out, but the public still has a lot of debt to get through. The other wonderful thing that the Greek public is now entitled to is what they call bail-ins. And what that means is when they did the last bailout, one of the conditions to get the bailout money was that if Greece came back again asking for more money, that the powers that be, which is basically Germany, could actually take deposits from the banks. So all the people who put money in the banks could lose a portion of their bank accounts. This happened in Cyprus, so it's not something that's unprecedented. It has happened before, and that's probably going to happen to Greece. So the Greek people really got a nice little surprise with this whole thing. But the bankers, they got out nice. Now, the biggest issue with Greece and why it really matters to the world economy is it's a domino effect. So again, I mentioned 60% of their debt is owed to other countries. And then this kind of shows you most countries in Europe are looking anywhere from 1.5% to about 5% of their gross domestic product being exposed to Greek debt. So right off the bat, if Greece defaults, some of these countries are going to have, they're going to lose money. They're going to lose a sizable portion of their, what is considered their GDP. So that's a big loss for a lot of these countries. And most of these countries have high debt levels to begin with. So those are only going to go up if Greece defaults. But the biggest reason that Greece matters, I think, is because if Greece does default, and if the European Union kicks them out, forces them off the euro, and they have to go back to the drachma, and let's say 2 or 3 years from now, Greece is doing pretty well, well, then what's Italy going to think? Or Spain? Or Portugal? Or Ireland? Or even France? Why would they stay with these enormous debt loads? Why would they stay in the euro? They could just default, go back to the franc, the lira, whatever currency, and then, whatever they had before the euro, and then 2 or 3 years of rough going, they'll be out of it. And this has happened. That's what happened in Iceland. So when Iceland hit the wall, they tried to do a bailout, and of course, all the different banks were trying to force them into the same conditions that they pushed on the Greeks, as far as austerity, as far as repayment, as far as extending the debt. And Iceland said, "We're not paying the debt. Screw you." And it did hurt in the short term. Their currency depreciated considerably, and it inflicted some pain. But here we are, 4 or 5 years removed from that, and Iceland's doing pretty darn well. So they're in a much better position. So I actually think it would be a good thing for Greece to default, for Greece themselves, because the first thing that's going to happen if they get kicked off the euro, they go back to the drachma. The drachma is going to lose a ton of value. Now, that's bad for the citizens in the short term because it's going to cost them a lot more money to buy bread, fuel, all that good stuff. But what it does is it instantly helps them make their economy more competitive. They can export a lot of goods and services. The other big thing is by defaulting, obviously, they're not going to be paying that debt back. So it gives their government breathing room. So I think long term, it's good for Greece if they did default. Now, while I'm doing this webinar, it's right after the Greek government has gone back and said, okay, we'll accept some more austerity, we'll cut pensions, we'll raise corporate taxes. They're kind of going back after the referendum vote where they said, no, to hell with you. Now they're going back and saying, oh, okay, we'll do it. We see some short-term pain. We just don't want to deal with that. I still don't know if that'll get passed. It's got to get through the Greek parliament. Hopefully the Greek parliament will be tough and not fold. I think they'd be much better off to take the short-term pain. And let me tell you, it's going to be painful, but that short-term pain is going to result in much longer-term prosperity for them. Otherwise, 4 years from now, we'll be right back here. Greece will be going through the same thing they've gone through before. So when you build up debt levels like they've built, when you get to have 1.75% to every dollar of GDP, you're going to have problems. You build up this much debt, there's no easy solution here. So it's going to be bad one way or another, and I think they'd be better off just to rip the Band-Aid off and get it over with. But we'll see. It's going to be interesting to see what happens. But it is going to have an effect on the markets, and it's going to, at the very least, it's going to have volatility. It's going to cause volatility. I don't know what it'll do long term as far as corporate profits or anything along those lines. It could affect the banking sector a little bit. But ultimately, what you're going to get from the whole grease dilemma is going to be volatility. Now, the other big thing, it's not quite as front page news, but it's still pretty big, is just oil. So oil basically went down to about $50 a barrel back in February, and it started to climb up and started to look pretty good. Looked like it had found a bottom, kind of got up to $60 a barrel and sort of flatlined from there. So things were starting to look pretty good. But of course, recently things have barreled back down, if you will, no pun intended, and we're back down to low 50s. So again, I think in the short term, nobody knows what's going to happen with oil. There's a lot of different issues going on with oil. You know, we've heard talks about how this is all kind of a ploy by Saudi Arabia. What they're trying to do is hamstring the American production of oil. So right now it costs Saudi Arabia about $10 to pull a barrel of oil out. And then even if they could sell it for $20 a barrel, they're making a pretty good profit. Whereas with the US producers, it's costing between $40 to $60 per barrel. So they have to have oil up at 70, $80 a barrel to really be making any money. So the thought is Saudi Arabia, if they can bring the price down far enough, they're going to basically put us, the US, out of business for a little while. So it buys them some time. But there's all kinds of issues. The whole Shia Sunni issue could pop up. So oil production could get, you know, we could see it continue to go down. At some point, what that's going to do, it's going to put a floor in for the price of oil. The other big thing is at some point we are going to find a bottom for oil. I don't know if that's $50 a barrel, $40 a barrel, $30 a barrel. I don't think it's going to take too long, because what's happening right now is you are starting to see oil being taken off the market. Oil drills they're coming off. U.S. production slowing. It hasn't been that fast, but as the price of oil continues to go down, if it does break below 50, I think we're going to see that accelerate. So as more and more production comes down, you're going to hit that point where prices are going to stabilize. It's just going to happen. That the demand that's out there is going to be so great that the price of oil is going to find a bottom and start to come up. It's just going to happen. It's a matter of time, supply and demand. I don't know when that's going to be, but I think that the quicker the price of oil goes down, the quicker we're going to find that bottom. And the thing I do like about oil, there really is no cheap part of the market. There's nothing that's really great value. But right now, you could make the argument that oil-related stocks are pretty well priced. So I don't think we're at that point yet where you want to get into any kind of concentrated position in oil, but I think that's coming up pretty quickly. But the big thing about oil that I think is it could really wreak some havoc on our economy. So not only are we going to see jobs go away if oil production slows, but there's a big part of the banking sector that's exposed to junk bonds that they had made for a lot of these oil companies in the US, as well as offshore rigging companies. So there's been a lot of debt issued to get the oil business and the natural gas business in the US going. And if those start to default, that could wreak a little bit of havoc on the banking sector, which again could easily manifest itself in the economy. So there is some serious considerations with oil, I think even more than grease. But of course, the long-term outlook is very solid for fossil fuels. I know people who hate the thought of greenhouse gases and, you know, climate change and all that good stuff. But hey, there's no getting around it right now. And just looking at China in particular. So in 1983, they only had 10,000 cars sold in the entire country. By 1990, that was 40,000. 99, we're up to 13 million. And it's projected by 2020, they'll have 30 million cars sold in 1 year. And by 2030, the demand for oil in China will be greater than that in the US. And even if you look at alternative energy projections, even the most optimistic, by the time we hit 2030, we're still going to be getting 80% of our energy from fossil fuels. So unless Elon Musk can really get things going with Tesla and some of the big auto manufacturers also jump on board, and I tell you what, at $50 a barrel, there's no incentive to do it. Maybe 150 or $200 a barrel, yeah, there's some huge incentive to really go to alternatives. But right now, even on the rosy projections of alternative energies, we're still going to have a lot of energy coming from fossil fuels. So one thing I am making a kind of a trade in accounts. I've been invested in master limited partnerships for a while. For those of you who don't know what those are, typically they're companies that support the commodity infrastructure. It could be shipping companies. It could be railway companies, but mostly it's going to be pipelines. So a lot of these companies are very involved in the oil business, but their business is not dictated by the price of oil. And they've got a great yield right now. It's close to 7%. So I really like the MLPs, but for some reason, the market is treating them as if they're oil denominated, as if they are affected by the price of oil. They're really not. But for right now, until we find a bottom in oil, I think I'm going to step out of the MLPs, kind of sit back and wait. But I do see myself getting back in once the price of oil stabilizes or starts to rise, just because these are very solid businesses and they have great cash flows. So then we've talked Greece, we've talked oil, and the last thing, of course, is China. And China, while it doesn't get a ton of the publicity that Greece is getting, China is probably a much, much bigger issue. So the Chinese stock market has been on an absolute tear the past year and a half. And even though it has now come down more than 30% from its peak, it's still up for 2015. It's not a big up year, it's single digits, but it's still up. But the problem is they've seen such a rapid decline. Essentially, the second week of June, we've seen about a 30% decline in Chinese stocks. And they're really starting to lose control of it. And the government's doing everything they can to halt this. At first, their central bank started pumping in money, figuring, well, once we let the faucet go, just like it was to the rest of the world, once the central banks start pumping money, equities have some floor to them and they actually start to go back up. Well, that hasn't happened. So and then they started putting some restrictions on. They're looking at anybody that owns more than 5% in any company can't sell for the next 6 months. So that should help a little bit, but it didn't really stem the tide. And now they're even starting to talk about people who are shorting the market, meaning they're betting against the market. They're expecting to go down. They're inferring that they might throw these people in jail. They're doing whatever they can to try to prop this thing up. Now, the risk here is when you get that much government intervention or manipulation and the market does not respond to it, you could lose control. So the 30%, you might think, hey, they've lost control. That's a done deal. But they've done a ton and they're still seeing it go down. So if investors really lose faith that the government in China has any kind of control, this thing could get really, really ugly real fast. And the big reason that you're seeing this issue in China is it's almost like it's 1999 there. It's like the NASDAQ bubble. You have tons of people who are now putting all their money into the Chinese market. And in fact, they're not only putting their money in there, they're using margin. And if you don't know, margin is essentially borrowing against your account. So let's say you have $100,000 in a brokerage account, you might be able to borrow another $50,000 and invest it. And then you pay basically an interest rate on that $50,000. But what happens is if the market starts to go down, they have certain limits and that they expect you to keep in your brokerage account. So you could end up with what's called a margin call. So the government basically steps in, or the brokerage basically steps in and starts selling your positions if your brokerage account goes too low. And if you look at China right now, they've had about basically 10.5% of margin financing in their stock market. So this has gone up enormously the past year and a half. And it's gotten to the point where the margin financing is a part of their free float market cap. It's now over 9%. So that means of their total investable stock market, 9% of that is all due to margin. That's awfully high. And this was a photo I found out there. Here you have these little old ladies just sitting there doing day trading, and they're probably way overexposed. And I kind of joke here, they're on the computer trading, but can they work their remote? Most senior citizens, it's blank. They're DVRs showing 12 o'clock or whatever. They can't even use a remote control, but yet they're all in. Everybody's investing in the market. It's literally just like it was at the NASDAQ peak. So I think the lesson that I would take away from China is at some point, a manipulated market's going to let loose. It seems to be already happening in China. They are doing everything they can to stop this bleeding, but it's really not working. And I think it's really only a matter of time when the rest of the developed world starts to realize what the central banks have been doing, including the Federal Reserve, is just rampant manipulation. And if the faith ever leaves with the Fed, then we're in big trouble. Right now, most people in the market think the Fed has everything under control. But if it ever gets to the point where they don't think the Fed has control, it could get pretty ugly. So I've talked about the price of stocks in past webinars. Stocks are extremely pricey. When you look at the price to earnings ratio using what Robert Shiller, Nobel Prize winning economist, he uses a cyclically adjusted price to earnings, or the PE10. And even when you compare it to the 10-year treasury yields. So usually when you have treasury yields between 2 and 4%, you're looking at having longer term price to earnings at 15 or below. You can kind of see from this chart all of the blue here. That's when we have 2 to 4% interest rates in the 10-year, and then everything here is below 15. Right now, we're in a situation where the price to earnings of the stock market is at levels only surpassed at the peak of the tech bubble and then the Great Depression of September 1929. So it's really kind of an anomaly. And I don't know, again, at what point are people going to start to lose trust in the Federal Reserve? If they do, Katie, bar the door, it could get ugly. But what you can kind of glean from this, once you get between 4 to 8% in 10-year yields on the treasuries, typically at that point you start to see the capes a little bit higher. In those instances, anything above 16% is kind of normal, with everything here in the orange being the tech bubble. That was very high. But even if you exclude that, you still see, for the most part, rates between 4 and 8%, you have higher P&Es. Then anything beyond 8%, you start to see low P&Es again, well below 15. And again, that's basically because an investor could put their money into a 10-year and get 8 or 9%. Why take the risk of the market? So we're kind of in really a strange place for the market. It's extremely overvalued, I think, especially when you consider the amount of economic growth we have, the amount of debt we have, and the amount of debt that's out around the entire developed world. I think we have a lot of headwinds, and for the market to be priced this high, I think it's risky. But anyway, I just wanted to kind of touch upon those 3 issues. They're big issues. I've got a lot of questions on it. But if you want more information, please sign up for our monthly newsletter. You can do that at picketfencefinancial.com/education. You can also visit our YouTube site. Just put in Kirk Kinder, or go to our Facebook page, and we'll provide you with as much information as we can.